Hey there. Thank you for tuning in to Ryan Makes Sense. If this is your first time here, or if you have seen my content before, I just want to say thank you so much for supporting me and spending your precious time watching this content. I have a great video for you guys, and I'm hoping it will help boost your confidence when it comes to investing. Now, if you've never invested before or you are a master investor, there is similarities that both sides will feel, and that at some point in time we'll be like, man, am I doing this right? Like, am I making the right decision? Am I making the right call? Well, you know that feeling when you are at a market and you see your favorite deodorant. This is just for example, your favorite deodorant, your favorite eggs, your favorite makeup, whatever, on sale for about 50%. You know you are going to buy that because not only you have eggs or deodorant or makeup at home, but you're going to run out of that eventually. And if it's on 50% sale, you might as well buy it now, right? So take that same approach, but with investing in the stock market. Now, I know putting your money in the stock market can be scary. You are basically putting your money into the confidence of a company or an ETF, an index fund, a mutual fund, whatever whatever you're going to get into. But what if you had the confidence and the knowledge to know that you're going to be investing with a strong company? What if you knew how to decipher that between all of the junk that's on the stock market? Well, in today's video, we are going to just look at a high level of what you can look at to get comfortable purchasing stocks. So, translating this approach back to when you're at the market and you see something you've always wanted to get, but you've never really had the opportunity because it was too expensive. Now you see something you've been wanting to try and you take the leap. That's how investing with stocks and in stocks that you're not comfortable or familiar with should feel when you know the timing and the purchase is right. So let's go ahead and let's dig a little bit deeper into that. Now, before I dive into this next portion, I just want to preface everything by saying if you have not subscribed yet, please hit that subscribe button and the like. It really helps me out. And also, when you do take the leap of purchasing something you've never bought before and get out of your comfort zone, whether you're buying a car, you're going to go run in a marathon, you're going to buy new shoes because you need to walk more, or you're going to go running. Researching hikes, researching a new food you want to try to see if there's any ingredients that are harmful. Take the same approach with stocks. You don't need to spend hours and hours doing research. You can literally spend as much or as little as time as you want and really find what works for you. Now, again, a lot of my content is around you being honest with yourself. How would you feel if you put your money into a stock that went up or down? Would you buy more? Would you buy less? Would you sell? Would you freak out? Based like there's, there's a lot of things you need to ask yourself. Um, do you want a dividend paying stock that it's going to pay you 5% a year? That's basically where you invest in a company. Let's say you put $100 into Starbucks. Starbucks has a 3% dividend. So every year you're going to get $3 back from Starbucks. Basically a free coffee, like a drip coffee. So things like that. Based on think about your age, think about your risk, think about, you know, all the different risks that play into your investment, your purchasing decisions. So, um, what I'm going to show you is going to be very slim down and very bare bones. But I just want you to know that number one, do some more research on the site. Look into what a balance sheet is, what an income statement is, what a cash flow statement is. spend an hour of your time researching this stuff and learning because it will really pay off in the long term, especially if you become so savvy and you understand that the stock market is a tool for number one, transferring wealth from the unpatient to the patient, but also coupling technical analysis with fundamental analysis to create and align a narrative of a stock or a company that is not only gaining momentum technically, but also the company is at a crossroads and maybe they are about to break through into a new arena. Maybe they are a graphics and motion picture small cap company that is working with streaming services to really step up into that world where, originally maybe they were only involved with one or two films, smaller productions, microchips, things like that. And now they're really getting into the streaming world and working with the Netflixes, the HBOs, Disney, etc. That exists. Um, so really, it's do your research, but I'm going to do a quick and dirty example of, you can invest with confidence. You can beat the stock market. Don't ever listen to me. Don't ever follow my picks. Don't ever follow Jim Cramer. Don't ever follow Kathy Woods. Don't ever follow Wall Street Bets, Stock Twits, Yahoo Finance, CNBC. Because by the time, if you follow someone, you are already getting in while they may be getting out. So they already purchased the stock well in advance, potentially. And by the time you're getting in, they could be selling you their shares for a profit. So that's why I'm huge on showing you how to fish, because if you teach a person to fish, it'll feed them for life. You know what I'm trying to get at there. So with that said, we're going to jump into finviz.com. This is the number one website in the whole world. It will change your life. And this is just going to be a super generic scan for you to just give you a quick and dirty picture of feeling confident in yourself with investing decisions and, really empowering yourself to, look at something, spend a few minutes and be like, yeah, this is a good deal. Like, people got it wrong. Wall Street has it wrong. You look at, maybe you listen to the earnings call and you hear like, yeah, this is a powerful company. Or maybe you look at their finances, you dig into their quarterly earnings, etc. I'm going off into a tangent. I'm really passionate about this, but we're going to do quick and dirty. I'm going to I want you to feel confident when you're making investments or thinking about making investments. So let's go. Let's go for real. So we are on finviz.com. I highly recommend you use this on a desktop computer, laptop, maybe even a tablet, but not on your phone. It is not very mobile friendly. Again, this is finviz.com. So think of this as your drawing board. The stock market has 8,345 stocks in the market, and you can see right here, I'm kind of circling it. You can see it, yeah. So just a quick and dirty, high level, let's remove all companies with debt. So debt is going to be under 0.1. Long-term debt and regular debt to equity is going to be under 0.1. So these are going to be companies that have little to no debt. Now let's also look at companies based off what you can see, because I need to move the screen. Let's look at earnings per share growth over the past 5 years. If we're going to choose a company, we want to know that they've been performing for the last 5 years positively. So let's look at companies who've had positive growth over the last 5 years. So we went from 8,000 stocks to now 800. That is 10%, about a little bit less than 10% of the original pool that we were in. Perfect. Okay. Maybe you want to look at under a certain price range. I'll let you decide. Are you looking for a stock under 50 bucks, over 20 bucks? I don't know. That's up to you. So right now we're looking at stocks with little to no debt. They have had positive growth over the last 5 years. I'm gonna move my head and the screen at the same time. So now let's look at stocks that are gonna be growing for this upcoming year. And they're guiding to grow so for this year and then the following year. So let's go to EPS growth this year. We want it to be positive. All right. We're now at 610 stocks. And now EPS growth next year, we also want to be positive. All right. So we went from 8,345 stocks. Now we're down to 315. Bravo. So just right there, we have really, really narrowed it down. And there's some other things we can do. Let's go back to the other side really quick. All right, the quick ratio. Let's say we want a quick ratio over 1. And if you highlight these parameters, it will tell you what they mean. Create note cards for yourself. Literally study this because it can make you so much potential money if you are consistent and you learn from your mistakes. Again, you have to fail in order to grow. I'm just throwing that out there. So quick ratio is over 1, and the quick ratio is defined as an indicator of a company's short-term liability. The quick ratio measures the company's ability to meet its short-term obligations with its most liquid assets. The higher the quick ratio, the better the position the company is in. Perfect. So basically anything 1 and above means that they can meet any short-term obligations. Amazing. Um, I mean, I think everything else potentially is up to you. I like having high gross margins because that means the company is really efficient. I like having companies that have insiders buying and institutions buying. However, it will show negative depending on the time of the year. A lot of institutions and insiders in the company will sell their stocks at the end of the year to either get ready for options purchases, so they need to free up some cash, or they need to sell for tax loss harvesting. Maybe they need a little cash before the holidays. There's so many reasons why institutions or insiders will sell. So you have to make that decision on your own. But right now, we are looking at companies with little to no debt who have performed well over the last 5 years, have positive growth not only this year, but next year, and they can meet any short term obligations. So that is all really great. Um, I think anything more in terms of filtering for parameters is going to be up to you. Because if you want a company that's going to be a value company or a growth company or a dividend paying company, you're going to need to adjust those parameters on your own. So if you want a dividend from a company, go to dividend yield and select dividends over here. If you are looking for a higher growth company, you need to adjust a quick ratio because growth companies need to utilize cash um, for growth and things like that. Maybe have a higher quick ratio because those types growth companies might have extra cash on hand. Their debt might not be as low. Maybe they have higher debts because they're trying to grow. Um, Things of that nature. And then value companies, basically you can look at the target price and you want your stock price to be below the target price. So if analysts are saying Pepsi is worth X amount of dollars, but let's say it's at quite a bit less, that could be a potential value opportunity for you. Um, Also, having shares outstanding for value, a lot of those value stocks are going to have a lot more shares outstanding, a lot more stability, a lot less volatile. You're going to need to adjust a couple more parameters there. I'm going to leave that to you. I do have videos that show you different types of scanners for growth, value, and income. But in terms of getting familiar with, being confident in your choices, I think having this as a baseline foundation is setting you up in the right path. So let's just look at Acadia Pharmacy. I don't know. Let's look at this company. Acadia Pharmaceuticals. So, okay, you guys can see, we can see they make 511 million, but they lose 217 million. They have no debt here. You can see that their quick ratio is 4.4, meaning they probably have some cash on hand. We can see the earnings this year, 41%, wonderful. Next year, 32%, amazing. Sales past 5 years, 94%. That is wonderful. But we can see over here their profit margin is negative. So think about how you want to address or go into the stock market. We look at the chart like, oh, you guys can't really see it. Let me adjust really quick. I apologize, I'm on two different monitors. One is a lot higher than the other. So look at the chart. This is the same price as it was around 2013. Same price 2016, 2018 to 2019, and now it's back here again. Think about those kind of things. The company has no debt. Let's just go down. 161 million shares float. Let's just look at their income over here. So this is income statement is another thing you can probably find on YouTube for a quick video on how to learn that. But the trend I'm seeing, total revenue is going up. Cost of revenue is going down, meaning their products are selling more without them having to market them, which is really good. However, their net income is just getting out of control, negative 217 from 167. We want to see that stabilize. We can see insiders selling quite a bit. In terms of like why they're selling, sometimes you can see like for options exercise, we have Baker Bros over here. If you're familiar with Baker Bros, they're actually really big into pharma. So they're getting shares at 522. That's pretty good. So read an income statement. You want companies to be trending toward net income positive. You want their total revenues growing, and you want their cost of revenue staying steady or decreasing, because that means their products are holding up in the market and becoming a leader. Let's look at the balance sheet really quick, and I can show you. They have 147 million cash on hand. Total assets, 700 million. Total liabilities, 159 million. That is wonderful. Total debt, 0. Other liabilities, again, you would probably need to research their quarterly releases to see what their definitions are of liabilities. And from there, you'll see what they're paying on or what they owe. But in terms of that ratio, that's a good ratio. And then cash flow as well. Again, we saw that they were not profitable. It just kind of shows their cash. Net income, again, negative. Not a good thing. But, these types of things are things you can learn fairly easily. So yeah, with that, you guys, I hope I gave you a little bit more. I empowered you a little bit to feel a little bit, you believe in yourself a little bit more when making the decision on whether a stock or a company is worth investing in at a glance. If I had to look at this company, I'd want to go back and look at further data. So what we're doing right now is looking at fundamental analysis, basically. I like to couple that, like with what I said, is technical analysis as well. See if there's any patterns. And when I say that, like, is there a cup and handle? Is there a falling wedge, a descending wedge, ascending triangle. Looking at the weekly chart here, we can see there was a gap. You can see, yep, you can see there was a gap. And then this price action here filled the gap and then it went lower. So, you can play gap fills. You can choose so many different strategies that can set you up for success. Um, in the comments, let me know, how do you feel in terms of confidence when you approach or look at stocks? Are you intimidated? Having to make that distinction of, okay, is a stock being manipulated by a company? Are they purchasing a little bit of shares to make it look like insiders are buying? Are they releasing unaudited financial statements? That is dangerous. Is the CEO a sketchy person? Does the CEO, have they been in some sticky situations before? Are they a strong member of their community? Things like that. So, again, it all starts with everything I showed you on that front page, looking at debt, looking at earnings per share this year, next year, how they performed in the past, um, and really choosing to having that conversation with yourself. Are you okay to have some risk? Do you want dividends? Do you want something that's never goes up or down? You just want to park your cash? You need to make that determination, but I hope you can make that determination with confidence. Hope you guys are doing well. Thank you so much for your time. If you made it this far, please subscribe. I'll see you guys later. Bye.